Hello, listeners, and welcome back to the Community Exchange Podcast, where we talk to friends, old and new, about their careers and the future of the media industry. I'm Matthew Scott Goldstein, better known as
MSG.
Thank you, Dave Jacobs. As always, the Community Exchange Podcast is brought to you by OpenWeb, the company building a safer, fairer, and more trustworthy internet. Now, we have a great conversation for you. David, we first met in 2006, give or take.
Yep.
When I was at Dakota, which I've talked about many times, and you were at?
I was at AOL, which was advertising.com had been acquired by AOL.
Okay,
so
you were acquired in 2004.
2004, yes.
And then the ad.com people were running a bunch of the network side of the business.
Correct.
And then we fucked everything up when AOL decided to acquire Dakota.
Well, it made it interesting, that's for sure.
And what do you remember from back then?
I just remember a whole bunch of people running around asking, why are we doing this deal? And trying to figure out why 1 plus 1 wasn't going to equal 1.4 instead of 3.
If you drew the circles of ad.com and Dakota, they overlapped a lot.
Oh, yeah. They sure did. I mean, you had some interesting tech around retargeting that we didn't really focus on, but it was a pretty thin synergy case for sure.
Right. And that was 2006. And I remember once the acquisition happened, sorry, this was 2007. Once the acquisition happened, I would travel down to Baltimore on the train, and I would go to the Baltimore headquarters of ad.com, and I would sit there for 3 or 4 hours doing nothing. And I remember distinctly never being able to get a cab to and from.
Well, that's why everybody comes to New York and doesn't come to Baltimore. But back in the day, there was no Uber, so it was hard to get back and forth. And no, not the public transportation hub.
Okay, and what was your role back then at ad.com?
I was running all the publisher side teams, so all the distribution partnerships, business development, client services, and sales.
And ad.com was the biggest ad network in the world back then?
Yes.
They were like number one.
If you rewind a little bit, it was for 5 years. It was the largest ad network going all the way back to about 2003, 2002. This was, predates SSPs.
And it was started by the brothers?
Yeah, Scott and John Ferber.
Okay.
Founded in 1998, and I joined in January 2000. And then we raised like $57 million, and then like 2 weeks later, the dot-com bust happened. So everything blew up. Fortunately, we had all that money in the bank. And that gave us a little bit of a window.
And then you're in Baltimore, right? You lived in Maryland.
Yep.
You still live in Maryland.
I still live in Maryland, yeah.
Okay. And then ad.com was there kicking ass, right? And they were doing, what was the ad.com secret sauce back then in the day?
Yeah, so if you think about it, we were one of the earliest companies to do really machine learning-based optimization, conversion-based optimization, and retargeting, actually. Like one of the very first retargeting products was the advertising.com leadback product. We'd lead the user back to the site that they came from.
Okay.
We branded it Leadback. And the business was one that in the early days, we were simply buying and selling and doing rev shares. And then I remember the CEO calling me in and saying, hey, let's take $50,000 and just arbitrage and see what happens. And then we built the entire business moving forward on an arbitrage model. So we bought CPM, we sold on CPC, CPA, or CPM, and it worked. And we became a trading house more than anything else.
Okay. So Dave, we're back after some technical difficulties, had to switch sides, we're good to go. So you're about to tell the story about how big ad.com was back in the day.
Right. So I got there in early 2000, and it was chaos. The company had just launched 18 months ago, and the business was doing $4 million a month in top line revenue. So I actually was brought in to run a business analysis team. I'm a finance accounting guy by trade.
Arthur Anderson?
So a recovering accountant, yes.
Okay.
So I was doing that. The company was growing like crazy. The dot-com bust happens. Revenue starts to crater. And we have a huge layoff. And they said, good news, you have a job. The bad news is you're eliminated the position, so we need you to run these biz dev and client services teams. So I said, great, I've got a job.
Bring it on.
And we had like a little bit of time that we stumbled, but throughout 2000 and 2021, 2001, we just kind of like tightened our bootstraps, if you will. And then 9/11 happened, and like everything went to shit again. A bunch of companies filed for bankruptcy. So we started going to companies that had filed for bankruptcy and started to offer to buy out all their inventory. So
like who?
Remember Excited Home?
Yes.
So we went to Excited Home and bought every single ad impression starting in October 2001 from the bankruptcy trustee.
You sold it and you bought it for really little.
And we bought
number.
it for, I think it was 17 cents CPM.
That's a great story.
And we were making like $1.05 on it. And we were literally, I remember the day, like we walked in the next morning and it was an extra 40, 50K a day in revenue that we were making from this inventory. And we were running out of campaigns to run. We were running like these performance campaigns. It was like degrading. But from that point forward, at the end of that year, we were profitable.
And you figured out the arbitrage, how everything worked.
The arbitrage we had already started to figure out, but we just said, let's just go all in on it. Scott Ferber, our CEO, blessed it, and we said, let's give it a shot. And we made millions of dollars from this one inventory buy. And from that point forward, the business was profitable. We ended up growing it to the year we were acquired. I want to say the year before we were doing like 140 million of top line revenue. But then the next year after acquisition, we did about 220.
It's a lot. It's a lot of revenue.
And that, by the way, that's top line. So we had to pay publishers out of that. We were running about a 40% margin, but profitable. It was a good deal for AOL. It was a just under $500 million acquisition. And they kind of let us alone, which was good. That was the best thing they could have possibly done, was don't try to integrate that business into the culture of AOL at the time, because it was completely different than what we were used to.
Let's move. So this is 2007, the Coda acquisition happens. We met you, go to Baltimore, the whole thing. And then you stayed at AOL for another, 8, 9, 10 years?
Yeah, I did.
How and what was AOL like throughout that time?
It changed pretty radically. So the first thing I would say is we went through this phase where the company was declining from their core business, right? Member services, they had subscriptions. So their strategy was just go buy companies. And it almost didn't matter who they bought. They were just trying to trade cash flow for revenue. And every once in a while, one worked, but most of the time it didn't work. So one of their thesis views was buy a bunch of ad tech companies and put them together. So they bought Dakota, Third Screen Media, Quigo, all these different businesses. But a lot of times the issue is that you need to give them the room to innovate.
And it feels like today, fast forwarding to Yahoo owning AOL and everything else, they're divesting almost all those companies now, right?
A lot of them were gone a long time ago. Okay. But yeah, and some of them were divested since then. But for a while there, it was literally throw it up against the wall. There's a lot of cash flow. They're sitting inside of Time Warner. Nobody really knew what was going on. Time Warner is this $40 billion market cap behemoth. We end up finding ourselves in a position where Tim Armstrong comes in as CEO. That
2010, 2011?
Okay. Late 2009, early 2010. Yeah, I think it was right. I'm losing my dates, but
it's okay.
Around that time frame.
You're old.
Yeah, sadly. I was young when I was there. But that pretty much radically changed the company. It was sort of this, don't make big decisions, let inertia keep going, and things were dying there. And then, I give Tim a lot of credit. He didn't make every decision properly, but he wasn't afraid to make big bets, and he wasn't afraid to roll the dice. I mean, you buy a big company like Adapt TV, you invest in Patch.com. Patch.com was a terrible thing to burn money on, but they weren't all bad things. A lot of them were good things. And he was also not afraid to make big swings. He cut the cost structure down radically, sold a bunch of patents off for $1 billion plus. When the company was spun off, it was spun off at $23 a share.
So it was spun off as a publicly traded company?
Yes. And Time Warner did a tax-free spinoff of AOL as a standalone business in 2011, I think. Okay. At $23 a share, I believe it was. And it was sold to Verizon in 2015 at $50. So all things considered, that's not a bad.
Okay, then Verizon, it was Verizon AOL.
Yeah.
And that's when the bad stuff started to happen.
Well, I mean, it was hard to. It's hard
to live inside of a telco, right?
I mean, and you see that, right? I mean, look at what's happened. You have companies that are sitting inside of big companies like AppNexus, Xandr sitting inside of AT&T. That failed. You have Moat sitting inside of Oracle. That failed. Like the bottom line is these companies are managing the cash flow and EBITDA numbers that dwarf what you can do in ad tech, because these companies are $100 billion, $300 billion market cap companies. What are you going to do? Like $5 million of extra EBITDA? They don't care. Like they throw that in the trash. You have no one paying attention.
And then when did you finally leave AOL after 16 years? I believe like 2016 you left?
Yeah, so I left in 2016, and along the way, like...
And by the way, that was like me being at Viacom for 16 years. It's a long time.
And everybody looks around, they're like, why are you still here? And my answer is always, it doesn't feel like I'm here that long because I'm always taking on different things. We launched a business in Japan. We launched an SSP. We transitioned the business from an ad network to an exchange-focused model. So there's a lot of different pieces. in there, but I left a year after the acquisition.
Okay. And then where did you go after that? And how's this journey take us to where you are today?
Well, I've had a couple stops. So I went over to 33 Across, and they were basically an ad formats company that was doing kind of managed media sales. And we flipped that into programmatic. So I spent a stint there. And then I got the startup bug. I think it happened to a lot of people. And I just went out and founded a company called Conduit, raised some venture money, did that for a few years. We sold that business in 2021. And I learned a lot along the way. I literally had to deal with acquisitions on the table, acquisitions off the table, pandemics, additional funding rounds, all those things. So I learned a lot. That was a great experience to deal with firsthand, literally from $0 of revenue to selling the company.
Okay, and what did Conduit do?
Conduit was a video optimization company. So you're
still in the ad tech world, basically.
Yeah, 100%. Right? And what we did was we looked at because one of the big problems with video is a lot of times you win a video auction and the ads don't start because there's all kind of technical glitches that happen and nobody gets paid. So we had a technology that looked at how do you evaluate based on all the different inputs if that ad's likely to start based on the browser type, the player type, and all those things. So there's a lot of inputs.
And you're still living in Baltimore. You never moved to New York.
Yep, never lived in.
But are you in with all these new companies in 33 Across? Are you coming to New York all the time? What's that like?
Well, it's changed over time. It used to be everything was in person, right? You needed to do these meetings
before COVID. Everything was personal all the time.
Yeah, I mean, I'd say it kind of backed off a little bit even before COVID. I mean, what I realized was I'm sitting in AOL in the early 2010, 12 timeframe, and I'm doing meetings with people in Europe, meetings with people in Asia, West Coast, and I'm like, why are we all in offices, on big screen TVs, driving and flying everywhere? So I'd say you saw a little bit of that with technology in that time frame, but it wasn't until after COVID where everybody just kind of stopped caring, I would say, to a large extent.
Okay, and then after 33 Across, then Conduit, then what?
Yep. So I had a couple stints. I was a chief commercial officer at a company called Playwire Media, and what Playwire did was they worked with a lot of gaming companies to represent all of their inventory programmatically and through managed services, basically the revenue arm of those companies. And then spent a year at a company called June Group, which was a mobile app performance business.
Okay, and then it was hard with some of these companies just trying to figure it out.
Yeah, I think one of the challenges is what I like to do is work with companies that are at a certain stage, right? It's sort of like early stage to mid stage. And even within AOL, I enjoyed being at that business unit segment that was in this sort of $0 to $100 million level. And those are fun companies because you can have a big impact. You can really drive results. And what you inevitably run into is potentially, if you don't have transformative technology, you hit a wall and you have to figure out ways to game the system to grow.
And then sometimes you don't know until you go into that company. You realize it's not exactly what I expected.
If I had $1 for every time I was told something before I went to a company and what I realized what it looked like under the hood, I'd have a lot of dollars sitting on the table right now.
Okay. And then after June Group, when did you do the exciting thing I want to talk about?
So I left in summer of 2022. And, a quick personal story, my mother had gotten ill. I just said I needed to take a break. And I left the company in the fall of 2022. And I just spent time with my wife with my mother who was ill, with my wife and kids for a while, and just said I need an ad tech detox. Because it had been so long that I'd been doing nothing but ad tech and looking at LinkedIn and looking at Twitter and everything else.
Like enough's enough after a while.
Enough's enough. So I'm fortunate to be at a point in my life, in my career, where I don't need to immediately run out and chase the next thing. So I'm gonna spend some time, do a whole bunch of things that I'm interested in doing, and also spend some time with kids who are teenagers at the time.
Okay, and then you started an Amazon fulfillment company, correct? And I remember calling you. I'm like, that is awesome.
Yeah. So here's the backstory. I've always loved sort of marketplaces and arbitrage. So ad arbitrage. I had baseball card stands as a kid working at the flea markets, right? So it's all about how do you buy something and sell it for a higher price. And I started.
By the way, producer Andrew. That's the name of the podcast. How do you buy something and sell it at a higher price? I had to say that because we always work on that. Go ahead. Sorry, Dave.
And I think a lot of times in ad tech, we like to complicate things, right? But nothing happens until somebody sells something, and nothing sustains unless you make a profit. So it was really about, all right, what are the things in the world that I could do that, one, I can pick up and put down, two, I don't have to raise venture funds for. And I started my own Amazon e-commerce business. it did great, and it still does great, quite frankly. And what I enjoyed about it,
and I remember
was
you had a
that.
fulfillment center in Baltimore. You had people, and they did pick and packing. And
So that's a separate business. I can get to that too.
Okay.
Yeah. So I have my own. There's the business itself, which is basically listing products on Amazon storefront through a team that I outsource offshore. And then what I realized was there's this whole picks and shovels world out there, right? People that sell on Amazon, what do they don't like to do? They don't like to do their books, right? They don't want to do accounting. I actually thought about doing that, didn't get into it. They don't want to fulfill a product because it's a pain in the ass. So I actually opened a business up in Wilmington, Delaware, and hired a team, and they run that today. It does great. So they have 120 customers that are Amazon sellers, and they receive in a given day hundreds and hundreds of packages and pallets and ship things out. So
they receive the pallets from the manufacturer, then they ship it out to individual consumers.
Amazon always rules about how do you prep products and everything else, and that was the thing I hated the most, but everybody hated it, and I knew there was a business opportunity. So again, it's arbitrage. So if you think about arbitrage, baseball card arbitrage, you buy it and you break down the sets. Ad arbitrage, you buy CPM and sell it at a higher price, right?
I'm convinced.
Amazon, there's the product arbitrage, and then this is labor arbitrage, right? You're hiring people at an hourly rate, and you're charging a product per unit price, and you're making a profit. So I've always liked the arbitrage game. Stock market's not all that different, and that's
you just
sort of
need to have the capital and take the risk sometimes, like of buying your own merchandise and holding it and making sure you can sell it.
And it was fun, but look, I mean, at the end of the day, those are businesses that I don't need to be involved in. They run themselves, and I just sort of decided I had a couple swings left in me, so I thought I'd kind of open up the aperture.
And now your new business is in an arbitrage business?
I'm back in AdTech.
Okay, is it arbitrage? Are you arbitraging?
Well, I don't know if it's full on arbitrage, but we're definitely creating marketplaces, right?
Okay.
We're definitely operating in the space that I'm familiar with, which is around programmatic media at scale.
Okay. Let's talk about programmatic. So when you entered back in and through your Playwire and 33 Across in June, what did you see in the ecosystem? What are you seeing? What's out there? Anything of interest that you learned from all your ad.com AOL days?
What I would say is that the industry's definitely got more sophisticated, right? There's a whole bunch of companies that have done really interesting things around identity. There's companies that...
Do you want to name anyone that you really like?
I mean, like the ID5s of the world. There's a lot of companies that have done very interesting things in the space, right? There's a lot of people that have done interesting things around formats, right? CTV wasn't... I mean, I feel like I missed CTV, quite frankly, right? Because there between 2020 and now, right? CTV exploded. But my general view is there's billions and billions of dollars being spent on banners in mobile web, mobile app, and display, desktop, and that's a pretty big sandbox too. So I'll let other people deal with CTV and all the money to be made there, and I'll focus on what I understand and what I'm good at.
And regular video besides CTV, is that still of interest? Oh
yeah. That's something that our company, I'm happy to talk about that, but that's something that our company can obviously help and support.
But I want to talk more about the industry. So what else are you seeing out there just coming back in from the outside? Like what else
it was funny. I was on I've been up here in New York. It's the first time you mentioned coming up here all the time. I hadn't been up here for some time. It's probably been close to a year because I'd spent some time away. And I was at an event, and the event was excellent. But a couple of the panels, I literally could have shut my eyes and been in a time machine, and it could have been 2013. Because some of the conversations are around a lot of the same topics that were happening 2, 3, 4, 6,
Are you talking like
ago.
about measurement and attribution?
Measurement, attribution, the death of the cookie, like all these different topics that are, they're not new topics. They're still not solved topics. And I think as long as DSPs still use their own methodology to buy, and they are using and following the same incentives, I'm not expecting a lot of these things are going to change immediately.
Well, and is that because all the real innovation is happening in the big tech companies like Google and Facebook, and the innovation inside our little ad tech open internet world just not that great today? Is that what's going on?
There's no question that innovation is still happening, and a lot of these things are moving. Like if you look at identity, the signal you're getting the way you got 3, 4, 5 years ago is declining from the straight up cookie, and the additional identities and the pieces involved are driving more results and driving more value. But it's a slow burn. This is not everybody thought that, hey, the Google the Google sandbox thing is going to change the world, and they've backed off of that many times. And it's not so much a question of turning off the valve; it's the question of things are evolving and evolving slowly.
Yes. today is November 14th when we're taping this. I was at a dinner 3 nights ago, November 11th, and someone said that no matter what, there'll still be 10% of the users on Chrome will still have cookies, and that's still statistically big enough to do whatever the hell you want to do. And the CTV players love to have that type of a sample size.
Yeah, I mean,
so it's still there.
Yeah, for sure. And look, CTV's got a whole other set of problems and issues around fraud and various other things that people are going to uncover over time. But I'd say like the innovation in our space has definitely moved a lot slower than I would have expected it to.
Right, and that to me is concerning that the innovation's not there in the open internet, because I'm nervous with that innovation in the open internet, it goes to a dark place and all the dollars end up going to these closed wall gardens that have measurement and attribution and perceived as being safer versus the open internet. I get nervous that there's no one there to support the open internet holistically.
Well, there's certainly companies that are championing that publicly, right? Some of the big DSPs, et cetera, are talking about that.
Well, there's only one DSP left out there that's not Google, right? The Trade Desk.
There are a few others, but I mean, the challenges are so big right now. They're flexing, and people are also starting to think of them as not so much a defender of the open internet anymore either, right? There's a trade-off when you're 30 times bigger than the largest SSP by market cap, which is where the Trade Desk is today.
Yeah, versus PubMatic and Rubicon.
Exactly.
Right? Yeah. So and I just get nervous that what does it mean for the future of news and information publishing?
We've certainly done, because of the measurement companies, and I'm not blaming them, but because of the way companies take signal and take information, that has worked to the detriment of a lot of news and information companies, because the amount of times that companies are determined to be not brand safe because of having something referring to an accident or something referring to death, when it's a phrase that could be related to Taylor Swift concert.
Didn't Jonah talk about that from Mobian?
Oh yeah, he talked about it this week too, but that's been going on for years. And I remember,
but I think he's been talking about it and he figured it out and he has a solution.
I hope so, but it still needs to be adopted, right? So as long as IAS and DV, which are not necessarily in a bad way, but they're the too big to fail companies in sort of brand safety, they're going to need to change their methods or be willing to or get pushed to in order for a lot of that to change fundamentally.
Right, but if DV or IS changes their methods too much and they only say 1% of the articles or posts are not good, then they don't have a business anymore.
100%, right? And that's why they're getting in other spaces, right? Yeah. You look at where they're evolving to and going to, their growth is in adjacent spaces, not just brand safety.
So where do you think the open internet is in 3 or 5 years?
Let me break it down a couple different ways, right? So there's obviously the Google overhang, right? So what happens to Google and do they get split up, whatever the case may be? I'm not so sure that Google getting split up is good for publishers. It's not at all clear to me that that's necessarily good for publishers.
You're talking about the AdTech case or the search case and divestiture?
The AdTech case in particular, just because there's so many like weird cross-subsidization things that happen with Google, right? They have a free ad server. They've got pressure on their AdWords business that pushes up prices. There's a lot of different things that I'm not sure that's actually good for publishers. And I think ultimately they're probably going to get split up. I would not be shocked if they would. But
I think no matter what,
I think we have to watch what happens.
I think no matter what, GAM and AdX will be split off at some point.
That's the lot. That's like the least, from a consumer standpoint, that's actually an easy one probably to make the case for. That doesn't mean it's easier for publishers, and it doesn't mean it's good for publishers holistically.
No, but what I've been talking and hearing is that if GAM does get split off and then there's competition in the ad server for the first time in a generation, because the Google monopoly goes away, that maybe there's some significant investment in ad servers, and maybe the ad server is reinvented. Maybe it has measurement attribution built into it, and maybe it changes the entire dynamics for the publishers. I don't know.
Well, look, when I was at AOL, we looked at buying YouTube. We looked at buying Google. I'm sorry, at AdX. We looked at buying Google, the Ad Exchange, DoubleClick. We bought AdTech.
Man, would history be different if that happened?
We bought the AdTech ad server, which was the #2 ad server in the world, based in
I remember that.
Excellent. In many cases, the diligence was this is a better ad server. but they didn't have the AdWords demand plugged in, right? So if you think about
also
the demand pipes, and then in the US, obviously, it's hard to change ad servers, as you know. It's like getting off of Salesforce. So it's impossible to get somebody to change an ad server from a deep integration point. And when you layer everything on top of it, so I can't remember how we started this story, this reference, but when I said obviously the ad server part would be interesting. It's most interesting, I think, if one of two things happens. One, if the AdWords demand gets decoupled and it'll run anywhere, not just through what's it called now? Google something. It used to be
DV360.
DV360.
Yeah.
I think with the other formats, right? So CTV becoming more and more prevalent. CTV ad serving probably has a couple revs in it in terms of.
Okay, so we started. I said the next 3 to 5 years. You said you're going to put in a couple different buckets. Was that bucket one?
I went on a bit of a tangent there, but I'd say, look, I think in my view, there's a general perspective that in some period of time, if you look back 5 years ago, they'd say there's going to be fewer SSPs, there's going to be fewer points of buying through the pipes. And what we found is the way the incentives are set up, that's not happened, right? So the ability to, and I'm going to use some buzzwords here, but hear me out. The ability to add value and provide additional signal from the sell side over to the buy side is going to become more and more important. So when you have loss of cookies and loss of identity, that is going to become more important. The company I'm building now that I just joined is focused on providing a signal for the buy side around the likelihood of users being receptive to respond to the ads. And it's a machine learning company. It's a bunch of really smart people that don't come from the ad tech space. And
that's probably what you want.
That's
today.
what excites me about it, quite frankly. And it's one of the reasons that I got back into ad tech, because I was very bored with the fact that you still had all these SSPs trading the same stuff. And the predictions, though, have not happened, right? So if you were to say 6 years ago that more supply would be traded indirectly than 5 years ago, fast forwarding ahead, with the advent of sellers.json and ads.txt, people would laugh at you, but that's what happened, right? And the reason is publishers are pragmatic. They know that if they send more bids out to the buy side, that they're going to make more money. And by partnering with more SSPs and partnering with more supply sources, some of them providing unique signals and some of them not, that's actually going to make them more money. So one of the things that I believe in, and why what we're doing with our receptivity product at Contxtful is providing that signal to buyers is actually going to enhance value for the publishers and then deliver more results for the buyers.
Yeah, I just get nervous that publishers, if it doesn't go the right way and the search traffic coming from Google goes down, it just makes the publisher's life harder and harder as time goes on.
Oh, 100%. But that's been happening now for quite some time, right?
Right, so but it feels like it keeps on going down. It hasn't plateaued yet.
Yeah. And look, there's going to be use cases for publishers to be able to reduce their overhead costs in different ways, right? The importance of writing content isn't going away, but the ability to be smart about how content is generated and more cost efficiently is something that is going to evolve.
And then I think when Gen AI properly sits on top of publishers' content, so you can get the information however you want it, whether it's a summarize, it's an audio file, it's a video, I think that changes the way the news and information is consumed by the user, the end user.
Yeah, and also not everybody is a loser in this space either, right? When you talk about what you just mentioned around search results, companies like Reddit have benefited massively, right, from the other side of it, which is how things get put forth in Gemini, for example. So
yeah, I was talking to someone the other day, and we couldn't think of anyone else besides Reddit who was given the gift of Google search results like Reddit has since they went public.
They've killed it, obviously, and obviously a lot of that has to do with their traffic, but also putting, I think Jen and that team have put together a really good business.
Right, but then if what Google takes, Google can give away. Sure. What Google gives away, Google gives, Google can take.
Yeah, but it may not all be Google, right? With some of the other players in the space moving forward.
Well, and then I think the other players in the space like Perplexity and OpenAI and Claude Anthropic, I believe instead of them being search engines, they're really answer agents, right?
100%.
So like I don't search on Google anymore. I go to Perplexity, and 95% of the time I get an answer, which is what I want, not 19 blue links of telling me what the answer might be. And it's a nicer, different experience, but it takes a while to actually change how I've been doing something for 20 plus years.
Yeah, and I like the fact that now you get a lot of those results along with your search results, and at least in Google. So that helps quite a bit. But yeah, I mean, I think that's the thing that I find interesting is how little things have changed in a long period of time. And if you were to ask me to make a prediction 5 years ago, I'd have been completely wrong. So what I'm betting on now is something that I also may be proven to be wrong for. But what I will say is the macro trends are still good, right? More money is being spent on digital. More users or advertisers are looking for performance. We have a product, at least in my current business now, that is able to provide good signal around your receptivity, focus around ad response. So there's a lot of pieces that head down a direction that I like, and that's that I think is where I would say the business is. I wouldn't call it a macro prediction, but there's going to be a lane there that I feel very comfortable.
Yeah, and I think now that content, instead of being words on a page, changes so much over the next 2 to 3 years that I'm not sure how ads are in that. Like how are ads going to be in perplexity?
That's a great question.
Right. So like, I don't know how that whole next evolution happens. And
yeah,
I was looking at something the other day, and Perplexity is now going to have e-commerce ads.
Okay.
So does all of the answer agents skip search ads and go right to e-commerce ads, and they become more like Amazon than Google? And does it just become everyone wants to just buy something and that's what we're going to get?
Right.
Like, I think there's going to be so many fundamental changes in how ads are portrayed in the internet that everything's going to change. I'm not being very articulate, but I just think it's going to change so much.
It's just hard to forecast with a high degree of certainty certain things. CTV was relatively forecastable, but some of these other noisy things that haven't moved, I'm baffled by.
But the one thing I can tell you for sure is the Google search monopoly is over.
Yes.
Right. The amount of queries that Google's getting probably peaked somewhere
3 years ago
or 2024.
Maybe. Yeah.
This year, and it's going down. Like, I can guarantee you that.
Yeah.
Right. There's other ways to search or get answers. So that's all going to change. The question is, how quickly does it happen?
Yeah, and like you said, where does the revenue follow? Because there's not billions and billions of dollars being spent on all this.
Or does it all become subscription? Like, do I pay $20 a month to get my answers instead of having ads?
Yeah.
Okay. Couple more questions before we wrap up.
You got it.
What are your favorite hobbies, Dave Jacobs?
Well, I mentioned earlier, I collect sports cards.
Okay.
Love it. I've done it since I was 9. So I have a nice collection.
Oh,
I enjoy that.
That's the arbitrage. There's the arbitrage.
It's a good escape. So, I go to my cave in my office and disappear for a few hours. I love to exercise, get out and about, keep fighting Father Time's a big hobby of mine. So I do a lot of that. I love spending time with my kids. My son's a freshman at University of South Carolina. We're both big football fans.
USC.
So we're now SEC and Big Ten. I'm a Penn State guy. So we're splitting time between the two conferences.
Okay.
Yeah.
Producer Andrew, anything else? Dave Jacobs, thank you very much. Great conversation.
Thank you, MSG.
And thank you to all the listeners. And as I said last time, if you want to be on the podcast, DM me, let us know, and we'll get you on. Have a good day.